Okay, I'm genuinely trying to wrap my head around this. On one hand, you've got these proven moneymakers, right? Companies bringing in predictable, huge revenues today. And on the other, this like physics breaking potential way down the line. It really forces this urgent, maybe trillion-dollar question. Which tech revolution should you actually be betting on now?
Yeah, it really is the ultimate investment showdown, isn't it?
Mhm.
We're looking at AI, widespread adoption, immediate cash flow versus quantum computing, which is all about foundational change, and potentially massive asymmetric reward, but later.
Much later, potential.
Exactly. They're not really rivals in the same race, more like polar opposites on that spectrum of time and, well, certainty.
And that's exactly our mission today, a really forensic look at the data to help you navigate this whole complex landscape. We're doing a deep dive into the investment metrics, the risks, the allocation strategies, focusing specifically on market data, ETF flows, as of late 2025. Welcome to everything you need to know about finance.
And just a quick reminder, as always, we're exploring the information from the source material we looked at. This is purely informational, definitely not financial advice.
Precisely. And hey, if you find this kind of deep dive interesting, if it's helpful, please do take a second to like and subscribe. It helps us do more. Okay, let's unpack this then. The data paints two very different pictures. Let's start with the current giant, the revenue machine, the AI explosion.
Right. Artificial intelligence. Simply put, it's about building intelligent machines, ones that kind of work like humans think. The really key shift that the source material points out is recent history. Just a few years back, AI was mostly impressive demos in labs.
Mm.
But 2023 to 2025, that's been the big aggressive pivot to actual enterprise adoption.
So it's moved way beyond just a cool proof of concept. And this adoption is in specialized areas, right? Like drug design, automated coding, generating content.
Exactly, and massive automation of internal business stuff. It's not theory anymore.
Right.
Translates directly into revenue. Real money for specific industries right now.
And that revenue seems to flow into, well, three main buckets for investment.
Yeah, we can break it down like that. Makes it easier. First is infrastructure. This is all driven by the absolutely exploding demand for processing power, training the models, running them inference. So investment here means looking at companies making GPUs, those specialized AI chips, data center services, the networking, basically the picks and shovels of the AI gold rush.
Yeah.
That AI chip market is just seeing incredible growth.
Okay, picks and shovels, then killer two.
Cloud and platform services. Think of the big hyperscalers here. Amazon, AWS, Google Cloud, Microsoft Azure. They're kind of like toll collectors.
Toll collectors, how so?
Well, they offer the complex plumbing needed, right?
Yeah.
Hosting the models, managing the data pipelines, something called MLOps.
NLOs.
Machine learning operations. It's like the sophisticated factory floor for building and deploying AI models reliably and efficiently. Since almost everyone relies on these big cloud platforms, they capture a slice of the revenue, almost like a tax, no matter which specific AI model wins out in the end.
Clever. Okay, and the third pillar.
That's the application companies. These are often vertical SaaS firms, specialized software companies. They build AI, especially generative AI, directly into workflows for specific industries.
Like biotech, using AI for drug discovery. Maybe legal tech.
Precisely. Biotech designing molecules, legal firms automating document review, finance automating reports. They offer clear ROI and are signing big contracts now.
And the market data backs this up, the scale of investment.
Oh, definitely. If you look at broad tech funds with heavy AI exposure, something like the iShares U.S. Technology ETF, you're seeing assets under management well north of $21 billion. That size just shows massive market confidence, huge investment already deployed.
And for a fund to be labeled AI-focused, what's the criteria generally?
Well, our sources indicate they're either explicitly investing in AI development companies or maybe using AI itself to pick stocks, or they have significant exposure, maybe 25% plus, to giants spending big on AI R&D like an Amazon or Apple. Funds like, say, the Global X Artificial Intelligence and Technology ETF, ticker AIQ, that's a more focused play.
Okay, but here's something fascinating from the data. While AI is the established giant, this smaller, much more niche defiance quantum ETF, QTUM, its recent performance is kind of staggering.
It is a whopping 77.00% year-to-date price change as of our data point. It's just huge.
77%.
Yeah. And that massive volatility, that return, it shows that even without broad commercial revenue yet, investors are seriously pricing in the potential for breakthroughs. It's a bet on the narrative, really, not current cash flow.
Which forces us to pivot, doesn't it? From the, let's say, high certainty AI sprint to the much longer dated promise of the quantum marathon. So let's get foundational. Can you give us a simple explanation? What's the core difference computation wise?
Absolutely. Let's try. Think of a classical bit, what powers your phone, your laptop right now. It's like a light switch. It's either off or on at one.
Right.
Simple. Quantum computing uses qubits. And a qubit, well, it's more like a spinning coin. While it's spinning, before it lands, it's in superpositions, kind of 0 and 1, and sort of everything in between all at once until you measure it.
Okay, superposition and entanglement. That sounds even weirder.
Huh.
Yeah.
Yeah, entanglement is the really mind-bending part. It means two qubits can be linked, deeply linked, no matter how far apart they are. If you measure one, you instantly know the state of the other, instantaneously.
Okay.
And that capability, superposition and entanglement together, it just fundamentally changes the type of calculations you can do. Orders of magnitude improvements, but, and this is key for very specific niche problems.
Niche problems like.
Complex optimization, think logistics, financial modeling, simulating molecules for drug discovery or material science, cracking certain types of encryption. It's not going to replace your everyday computer for email or spreadsheets.
So quantum won't help with my email, thankfully. But it could help a pharma company design a new drug, or a material scientist find that elusive room temperature superconductor.
Exactly that kind of thing. Problems that are just impossibly complex for even the biggest classical supercomputers today.
So where is this tech now in late 2025? Is it still just academic theory, or is there actual commercial movement?
It's definitely moved beyond pure theory. We are seeing the beginnings of commercial activity. Major players offer quantum access via the cloud now. There are on-premise research partnerships happening. Companies like IDM, D-Wave, IonQ, they're running real-world pilot projects, trying things out in material science, financial optimization. The big challenge is still scaling the hardware and, crucially, correcting errors. Qubits are incredibly fragile, but the infrastructure for commercial access is being built.
Okay, access is being built, but what's the timeline? If I'm buying that QTUM fund today with its 77% gain, what year am I really betting on for significant impact?
You are absolutely betting on the 2030s, maybe even late 2030s for broader impact. Industry analysis generally suggests quantum computing revenue, specifically computing, might rise meaningfully, beyond just a few billion, sometime in the early 2030s. The wider quantum technology market, including things like quantum sensing and communication, could get pretty large by, say, 2035 to 2040. It's definitely long-dated optionality you're buying. Right now, the focus is often on hybrid approaches, classical computers doing most of the work, handing off the super hard part to a quantum processor.
Okay, 2030s, that's a long wait. Let's put these two head-to-head now, focusing on the investor view. You mentioned QTUM's huge gain, given the tech is maybe a decade plus away from wide use. How much of that gain is, real progress versus just market hype we should be wary of?
That is the core risk question, isn't it? With AI, the technical risk is lower now. We know it works. The ROI can be proven. Monetization is happening relatively fast. The main risks there are more about execution, fierce competition, and maybe the core models becoming commodities. Quantum, though, it carries extremely high technical risk and timeline risk. Many of the pure-play quantum companies are pre-profit, highly volatile. You're betting on fundamental physics breakthroughs. It's a truly asymmetric bet, potentially enormous reward, but only if they can actually build large-scale, fault-tolerant quantum computers. Huge if. And the market size difference today really underscores that risk difference.
It's incredibly stark. AI is already a multi-hundred-billion-dollar opportunity, heading towards even bigger numbers by the early 2030s. Growth rates, CAGR, in the high 20s, maybe 30% for generative AI specifically. Quantum computing revenue today, single-digit billions globally, maybe tens of billions by 2035 for the computing part alone. So yeah, AI is the established multi-lane highway. Quantum is like building a specialized high-speed tunnel through a mountain, incredibly difficult, potentially revolutionary if you succeed.
And beyond size, the sheer speed of innovation must be totally different, which changes how you'd invest, right? Totally. You have to track them differently. AI product cycles. Fast. Months to maybe a couple of years. You see new models, new applications constantly.
Right.
Quantum hardware cycles. Multi-year. Research-heavy milestones. We're waiting for big fundamental breakthroughs, like demonstrating logical qubits stable, error-corrected qubits, not just slightly better software. Plus, finding the talent. There's a huge scarcity of specialized quantum engineers, much more acute than the talent crunch in AI, which is already significant. That's a real bottleneck for quantum companies.
Okay, so massive differences in certainty, timeline, risk profile. You clearly can't just pick one and ignore the other if you're thinking long term. How should someone think about allocating capital between them?
Yeah, it's about balance. The most common framework people talk about is the core satellite approach. Think of it like building a portfolio team. Your core is your reliable foundation. This should be weighted more heavily towards those AI-related revenue-generating companies we talked about, the cloud providers, the key chip makers, maybe some stable SaaS companies clearly profiting from AI now. That provides stability and captures current growth.
And the satellite is the speculative bet, the moonshot.
Exactly. That's where you put a smaller slice of your portfolio, maybe say 10%, maybe up to 30%, depending on your risk tolerance. This goes into the higher risk, pure play quantum names, maybe some niche AI startups too. It's for that elongated optionality. If quantum does deliver fault-tolerant systems, that smaller satellite allocation could provide really significant upside, potentially offsetting some lower returns or risks in the core AI holdings.
That makes sense. And are the companies kind of bridging the gap, working in both areas?
Definitely. And those could be really interesting synergistic investments. You should look for companies positioned to benefit either way or using one technology to help the other. Think about companies using AI to actually speed up quantum research, designing experiments, analyzing data, or firms planning to integrate quantum accelerators into future AI computing stacks. The big cloud providers are doing this, offering both AI services and quantum access, and companies like NVIDIA providing the core AI hardware, but also tools for simulating quantum systems and working on error correction. They're well positioned. They potentially win regardless of which timeline plays out fastest.
Okay, finally, let's talk pitfalls. If I see that 77% QTUM return and feel the urge to jump in, what red flag should I watch for? How do I avoid just chasing hype?
That's crucial. You absolutely have to avoid pure hype chasing, especially in quantum right now. Demand clear, verifiable milestones. Look past the glossy PR and find evidence of real technical progress or, eventually, clear paths to revenue. You also need to understand the tech moats. The competitive advantages are different. For AI, the moat might be proprietary data, a strong distribution network, sticky recurring revenue. For quantum, it's much more about fundamental intellectual property, unique fabrication capabilities, maybe key partnerships with governments or research labs, very different things to analyze.
So that brings us to the wrap up, maybe the 2035 vision. If both deliver, what does the world look like? AI is sort of everywhere.
Pretty much. By then, you can expect AI to be deeply embedded across almost all enterprise and consumer workflows. It becomes the universal layer for efficiency, automation, personalization.
In quantum.
Quantum serves as the targeted breakthrough engine for specific high-value problems. It powers specialized solutions in material science, chemistry, drug discovery, complex logistics, maybe some areas of finance places where classical computing fundamentally hits a wall. They work together, AI and quantum, but on vastly different scales initially. Remember, AI's market is already huge. Quantum's will likely still be in the tens of billions by then.
So the provocative thought, the key takeaway for investment success here, it seems like you need to track completely different signals for each.
That's exactly right. For AI, you're tracking faster-moving signals, shifts in pricing from model inference, new model architectures gaining traction, major enterprise contract wins, adoption rate.
Or business-focused signals.
Correct. But for quantum, you're tracking fundamental research milestones. You're looking for announcements about fault tolerance demonstrations, achieving reliable logical qubits, meaningful proof-of-concept wins in those key industries like pharma or finance. These are slower, more binary bets on the underlying physics actually working at scale. That indicates real progress, not just market excitement.
Fascinating. So track the business for AI, track the physics for quantum. Got it. Well, if this discussion about balancing near-term revenue with long-term potential and navigating thematic tech investments has got you thinking about your own portfolio construction, we definitely recommend exploring some of our other deep dives. For instance, looking into ETFs focused on related fields like robotics, think Robo or BOTZ, or maybe broader tech segments like the iShares Global Tech ETF, IXN, or the iShares Expanded Tech Sector ETF, IGM, could provide really valuable context. Thank you for diving up with us today.